as you all know, is Rethinking Systemic Financial Risk. And we're going to move from diagnosing the disaster to really trying to shape the solutions to addressing systemic risk. We have a panel. Good morning, Guillermo. We have a panel of people who have been on the front lines, both in the government and in the largest market participants trying to react and deal with the most significant crisis since the Great Depression. As you all know, no one was spared in this particular crisis. There was no immunity, and the solutions are going to require, again, every participant, both private and public, responding. I'd like to introduce our panelists and give them a couple minutes this morning just to provide their perspective on how they think about the crisis. And we're first going to start with Jaime Caruana, who's at the BIS, and will provide his perspective of kind of where we are today.
Thank you. Good morning. Perhaps my first point will be an obvious one. One of the big lessons of this crisis has been that we need to address properly systemic risk. It was systemic risk, system-wide risk was clearly underestimated. It was underestimated the linkages between financial institutions. It was underestimated the linkages of the financial institutions with the economic cycle, and we have been suffering these consequences. My second point will be that the international community of regulators, central bankers, have been working very hard to address the key elements of this systemic risk, and there are a number of areas that they have been concentrating. I would like to mention these areas very briefly. First one will be the capital, liquidity, provisioning regulation. This kind of regulation, this is going to be strengthened with new things that are there, such as this conservation of capital and additional buffers that are counter-cyclical. There are new elements that we can discuss if necessary. The second would be to make sure that the supervision can provide a good oversight, the perimeter of the supervision, all these kind of things would be the second area that is being discussed. The third area would be the structure of the institutions, whether there should be some limitations in some areas or on some activities. Again, very important and relevant topic. The fourth, I think, is particularly critical, which would be the resolution frameworks, especially cross-border resolution, to make sure that a complex institution, a big and complex institution, a very interconnected, can be wound down without creating real trouble. And that's going to be one of the key issues and one of the most difficult issues. And finally, improving the infrastructure. For example, the central counterparty for trading OTCs or organized exchanges. These are the main building blocks that I think address the main fundamentals elements of the systemic risk. But I would like just to finish with one more remark. This is all about regulation. Regulation is part of the solution, but clearly it's not the whole of the solution. And I would like to say that we should understand the limits of what can regulation do, and we should need to make sure that we address systemic risk, the help of other areas that has also to be improved. Macro policies have to be more symmetric in relation to the busts and booms. The private sector has a lot to do. Regulation will try to make the private sector incentives to be more consistent with financial stability, but they have a lot to do. And finally, cooperation, international cooperation will have also to be strengthened, and the G20, the FSB, hopefully the BIS, we will try to contribute on that. Thank you.
Thank you, Jaime. Our second panelist is Ibrahim Dabdoub, and from the National Bank of Kuwait. And as you all know, many commentators had suggested there was really a decoupling in our world economy. And I think that Ibrahim was going to kind of dispel that notion. We all know now that trade flows were severely impacted and capital flows to the emerging markets. Ibrahim?
Thank you very much. I think persistent external imbalances are really one of the main facets of the build-up in that. And I think somehow we have to tackle this part of the imbalances simply because it's really creating a lot of problems. We have to tackle the imbalances between China and the United States, between the Gulf oil exporting countries and the United States, and so on. Free capital flows also is a major problem, especially hot money. And I think those of you who can remember the Asian crisis, one of the main facets at that time was really free capital flows. I think to impose restrictions on capital flows is another problem. So where do you stand there? As far as trade flows are concerned, yes, the trade flows were affected simply because there was a decreased demand, and it was really a result of the decreased demand. But I'm more worried about really the external imbalances, basically, and I think they are outside the realm of the macro-prudential regulations.
Thank you.
Thank you.
Our third speaker is going to be Bob Diamond from Barclays, who had a very unique role in the crisis on both sides of the Atlantic. Bob?
Thank you. Excuse me. Thank you, Suzanne. I thought an interesting introduction would be around the debate around too big to fail. I had an opportunity in December to make a presentation at the Chatham House in London. And I titled that presentation, Too Big to Get Wrong, because I think this debate, this issue, is clearly too important to get wrong. So why are banks big? And I think you have to step back from some of the rhetoric and answer the question of, did banks get big because they wanted to, or were they following their clients, were they following their customers, and were they following their markets? Was it for an economic purpose? And I think it's clear, particularly in the post-communist world that we have lived in, that banks have been following the markets and have been following the free trade initiatives and have been providing an important function in terms of helping corporates, helping governments, helping investors transfer risk, particularly transfer risk across border. And if you look at a number of client segments, we attended a meeting recently in Washington with 30 of the most important CIOs, chief investment officers, again, of 30 of the largest pension funds in the world. And if you ask this group, are large, integrated universal banks important for you to get access to the markets and to get access for the investments necessary for your pension assets? It's clear and it's uniform. If you sat with a group of finance ministers from around Asia, something that could be done here at Davos, the answer would be clear of the importance of the integrated universal banks in terms of helping them transfer risk, particularly transfer risk or take risk across border. So I think you have to ask yourself the second question of, is regulation up to it? And we have seen the failure of a couple of large banks. We've seen a couple of large banks take significant direct investments from governments, and I think in those cases it's clear that there was ineffective regulation and, more importantly, ineffective management, particularly around the management of risks. But it's important that in my mind, I've seen no evidence, I've seen no academic study, I've seen no analysis that suggests that shrinking banks and making all banks smaller or more narrow is the answer. There is the way, working through the G20, as is happening now, to have an effective regulatory framework to resolve issues in the larger, well-managed, integrated universal banks. And I'm afraid if you step back and say that too big or large is bad and large is systemic, and we move to a more narrow banking, that the impact of that on jobs, the impact of that on the economy, particularly global trade and the global economy, would be very negative.
Thanks, Bob. When we talk about the financial crisis, we often lump all large financial institutions into one basket, particularly given the failure of AIG. I think we sometimes think insurance is the same business. And we've got Stefan Lippe from Swiss Re today, I think, who will provide an interesting perspective on that.
Thank you, Susan. Good morning, everybody. I would like, if I look at the type of activities to deal now with the crisis, I think we can cluster them in two parts. One is, as Jaime and Bob pointed out, to go for the too big to fail. I think it's more a to be interconnected to fail than really a too big to fail question. And the other is a solution which sounds like just everybody has to have more capital, then the total world is more safe. May I now shed a light from the view of an insurance reinsurance industry on that one? This question of to be too interconnected or too big to fail is not an insurance reinsurance issue. And the one case you mentioned, Susan, was not the insurance activity, but the banking part of it. So we rather in the future should learn here that we are really properly able to differentiate which activity is insurance reinsurance and which is really clear banking. But in the insurance world, there was a good study of the G30 in 2006, which analyzed if 20% of the reinsurance market fails, which is the most interconnected with insurance company, what this will do. And the result of this analysis was it will not cause a crisis. So this too big to fail is not the major issue in our shop. And this other question of just everybody, banks, insurers, holding more capital, as long as this is not risk-based, doesn't help. It's very simple. If we all are forced to hold more capital, this is even an incentive to go to the more risky part, because then you make your return on equity. It has to be risk-adjusted. Can I change the discussion and look at the situation from a totally different point of view? There are two questions. One is, can one company be the start of an avalanche for a crisis? This is the too big to fail question. The question where I think we have not digged into yet really is a question, how can, and this was, in my opinion, the reality, even what we saw now and in the past, how can risks, products, market behaviors really drive this contagion, this spreading out the risk, spreading out the wave over the globe? There we have to dig much deeper, and there we should not forget how markets work, whether products are regulated or not, how a regulator work, and we should not forget accounting and rating agencies, because all these type of institutions give incentive how much capital do you hold and where you go. I think there we should take a bigger picture. But to be more positive, to talk about very good developments, 3 in the insurance sector I like very much. First, the EU has taken the right decision with Solvency II. This is an economic-based, risk-based, and comprehensive view on the total company. Not only the asset side, but all the risk, operational risk and everything. And we very much support this. Of course, there are technical details, but the big picture is right. The same is, by the way, the so-called Swiss solvency test, which is the same. Very good development. A second, where we as insurers learn from our friends from the banking world, is that regulation has now started in Europe to take the college system. So all the regulators are sitting together and talk about especially big international groups. This is a very good step forward where we could learn from the banks. And a third area now in the US, really I hope and touch wood that at the end of the process we will get this Federal Insurance Office, because it is not, you cannot imagine that an international global crisis can be dealt with if in the US we have to deal with 50 regulators. So this is one of the major steps forward we would like to see.
Great, Stefan, thank you. We thought it was important to add to the panel today Jonathan Nelson from Providence Equity Partners, a PE organization, to provide his perspective.
Thank you, Suzanne. It's interesting, and listening to the debate and the studies around systemic financial risk, because the first question I asked myself in looking at various proposals, and there's a big one before us now that was unveiled, at least in a skeletal form, a week ago in the States, is what are we trying to solve for? Is it systemic financial risk? Is it to respond to populist anger? Is it to curb bad behavior? Is it to answer the question of too big to fail, which I think is a different question than systemic risk? Because depending on what we're solving for, and in some cases not clear we actually need to solve for, which I know sounds heretical today, that tells me, or begins to tell me, whether or not the proposals make sense. I think most serious practitioners and students of the financial crisis would probably put their finger on systemic financial risk, which I don't think most of the proposals actually are solving for. It's a different motivation. And let's assume for a minute that that is the problem. It seems to me the right framework then to evaluate a proposal would be, does it reduce the probability of the next crisis? And by the way, probability, I think the answer realistically could never be zero. As sure as we're sitting here, there'll be another crisis. It'll probably have another trigger point, so whatever we're solving for a year ago might not adequately protect us next time around. But the second feature, so it's probability of failure, systemic failure, and then the cost. And the cost should be the cost to the public. What is the dollar expression of saving the system from Armageddon, which almost happened a little more than a year ago? Do current proposals, will they work? And in particular, the Volcker plan. I think this session, there probably would be fewer folks in the audience, and it would be less lively if this happened 2 weeks ago, because 2 weeks ago one could have said arguably very little has happened in the way of proposals since the crisis. I mean, there's been discussion, of course, but very little action that attacks the kind of fundamental issues that were revealed in September of 2008. I'm not convinced they do. I think we need reform. That's clear. I'm not sure carving out bank activity, in particular private equity, proprietary trading, and hedge funds, not sure how much that had to do with the financial crisis. Query, what are we solving for by carving that out? I mean, there are those who argue that less diversified banks are actually weaker banks. But let's assume for a minute, but on the other hand, there's something that makes sense about level playing field and subsidized or guaranteed depositor money applied in more risky areas. But that sounds to me more about smarter capital requirements than prohibitions. Certain activities probably should have higher of attendant capital requirements, and segregation of activities in the event of a failure sounds like a good thing. But while the focus last week and this week is on banks, it's interesting to note that the bigger problems are actually at non-banks. If you look at at least in the U.S., the TARP money that was either loaned or invested in equity, which to me will end up being not much different, actually non-banks accounted for 54% of the rescue funds. AIG, Fannie Freddie, GM, Chrysler. And that was at the time of crisis. Today, after giving effect to return of capital by borrowing or institutions or troubled institutions, that number is now 85%. So only 15% of TARP money actually went to banks, which, if we're solving for public exposure to a financial crisis, we need to be focused on financial conglomerates, not just banks. And so any proposal must take that into account. And of course, and it's especially apt sitting here at Davos, it has to be international. It can't be one country's proposal. It has to be universally accepted. By the way, that sounds like a very tall order. Feels a little bit like global warming in Kyoto. Everybody agrees in concept, but there's always some provision that you disagree with, or you're unwilling to cede authority. Any country it's a tough ask to cede authority to an exogenous entity on such a critical component of our economy. So but we know from past experiences that has got to be an element present for it to work. So for me, the question is, what are we solving for, and will it work? And the last point would be, I'm relieved as a private equity practitioner that finally we're not in the gun sights of the government, and unfortunately it's the bank's turn, and so I thank you for that. Because I think that one of the learnings of this last crisis, which we've been saying for years, but unfortunately we have a crisis now to point to as example, is that we're not contributors. In fact, we play no role. That is, at least private equity, the best case I think could be applied to that asset class. we had no role in the crisis, in part because we are so small. I mean, Providence has $22 billion of assets under management. That's small by world standards. Actually, I think we may have a bigger role in recovery than we will in crisis, but that's another topic.
Thanks, Jonathan. I'm sure that will spur some questions from the audience when we get to them. Finally, I'd like to go to Guillermo Ortiz, many years at the Central Bank of Mexico and a commentator on this crisis in his new capacity in academic life. And Guillermo, I'd love to hear your perspectives.
Thank you. Let me start where the previous speaker left and try to analyze what are the problems that we're trying to solve. Okay? The financial industry, and I'm not confining myself to banks, but particularly banks, are by definition leveraged institutions where the owners have limited liabilities, okay? And the capital is subsidized. It's subsidized by the existence of deposit insurance, mainly deposit insurance, and the possibility of extending the safety net using taxpayers' money. So if you put all these things together, there is clearly an incentive to take more risk than it would be under any circumstances socially desirable. So I think this is the setting. And financial crises have repeated themselves through history precisely because too much risk has been taken at different stages of time by the different institutions. So there are basically two, I think, proposals on the table. And Jaime alluded initially to the work that has been done by the Basel Committee and the Financial Stability Forum. And it has focused mainly, I would say, on three aspects. One, of course, is strengthening the capital base, that is mitigating the amount of risk that financial and banking institutions will take. Also working on liquidity requirements, so as to avoid maturity mismatches, currency mismatches, and so on, which in different stages have led to the problem. And of course, working also on incentives, that is compensation, to the extent that managers and directors are compensated by short-term results, they're prone to take additional risks. So I would say the first set of proposal is, say, risk mitigation and try to correct for the natural, I would say, incentives that are embedded in the banking industry. The more recent proposal that was unveiled by Mr. Obama and following Mr. Volcker's idea, the first thing I would say is that Mr. Volcker has been very consistent. If you read the G30 report that Jaime and I worked on about a year ago, it's all there. I think that the idea is to limit the size and the scope of activities of large financial groups. It's a different approach to risk mitigation. And one can discuss whether it's actually desirable or even possible to, let's say, limit the size of institutions and to limit the interconnectedness of the institutions. But the ideas of banks sharing the hedge fund business, the private equity business, and limiting or severely curtailing proprietary trading is something that Mr. Volcker has been advocating for a long, long time. I think the essential issue in this second proposal is the separation of banking from commerce. This has been at the heart, I would say, of the thinking since the 30s in the US banking industry. Now, how do you find commerce? That's a different matter. But according to Mr. Volcker, of course, all the sort of additional activities besides traditional banking that the institutions have made, that is, going into the private equity business or hedge fund business, that is somehow related to commerce. So then the idea is consistent of separating these activities. Now, there's a big issue as to whether you can really distinguish the sort of market-making function of large, complex institutions from that of proprietary trading. That's a fuzzy definition at best, but the details should be fleshed out going forward. But I think that this proposal that was put together very recently by Mr. Obama following Mr. Volcker is well, you can look at it from a political perspective, but I think it is a response also to a perceived effort on the part of the banking community to go back to business as usual. And I think that banks largely have misjudged the deep feelings of the public regarding the devastating effect of this crisis that has been originated by, I would say, the taking of very, very excessive risks on the part of the financial sector. This is obviously, this whole thing started with global imbalances and perhaps loose monetary policies and so on and so forth. That's previous history. I mean, what we are dealing with is the consequences of actions on the part of the financial sector. Let me stop here.
Great, Guillermo, thank you. And probably a good place to start. We've put the couple proposals on the table that are out there. I'm going to turn to Jaime, who has the difficult task of harmonizing many different points of view. And you now have some very significant national proposals out there, including the Volcker Plan. And just wondered how you think about reconciling when you've got disparate views.
First, I would say that harmonizing would not be the word. Probably the word would be increasing the consistency of the different approaches at national level, and this is part of the continuous work of many institutions, the Financial Stability Board, the BIS, Basel Committee, many institutions are doing that. And I think we should not underestimate the huge efforts that are being done on that aspect. This is done on a continuous basis. And the first thing I think to support that is to have some standards, some kind of international standards. This is the first level, but it's not enough because then the implementation can be different. And we have seen that even before, so this is not new. The implementation of the standards was not the same all over the place. We had the same standards, but they were implemented differently. And by the way, the crisis manifested differently in one country or another with the same regulation, but different implementation. So implementation is as important sometimes as the standards, and we should take that into account. But the effort to not fully harmonize, but reflect the differences, but at the same time increase the consistency is quite important. Now, there will be always national differences, and I think we need to understand that. And the truth is that the national differences where the regulation was a little bit more strict has not worked badly for these countries. So I think a little bit the issue of the level playing field is extremely important, but the issue that those countries that are more strict will be in an inferior condition or will be at a disadvantage, I'm not convinced. There are many cases where those that have applied more stringent application of some similar standards have produced better results, especially in crisis. And in that sense, I think that, that the message that comes from the proposals in the United States is that on this occasion, the reform of the agenda of reform of the financial sector is quite serious. There is a determination to go to a different place, not to the same place where we come from. And some countries will use the range of tools, because what I described in the 5 areas that I mentioned was a range of tools, and in each of these areas there will be a range of tools. Some countries are determined to use the full range of tools, going even to the radical solutions to make sure that some of the critical elements of the crisis, and I agree with those that said that the too big to fail perhaps today should be too interconnected, too complex to fail, is one of the critical issues and one of the most difficult. Perhaps I should have started saying that this is a very, very complex issue, but I guess that listening all the presentation, it was obvious how many sides and how many angles you can have. And unfortunately, we are asked to speak for 3 minutes, but there has been work for more than 2 years on changing this, and condensating that in a few minutes is not an easy task. But I would like to send a message that a lot is being done to increase this consistency in terms of sharing information, in terms of sharing the same standards, but allowing some differentiation, because the systems and the institutions and the models are different, and this also needs to be taken into account.
Jaime, thanks. As a follow-up, I'm going to ask 2 of the private sector players, Stefan and then Bob, just from their perspective, how important is the consistency? Because they're the ones that ultimately have to kind of live with the rules and really implement them. And Stefan, I'll start with you.
Okay. If I start with a helicopter view here, everybody is talking about responsibility of politicians, regulators, and others. I think those who run a company are in the first place responsible for the risk management and making the company safe. So I like to do that. But now what's about the consistency Susan's asking for? Allow me to give you a very simple, down-to-earth practical example out of my own shop, Swiss Re. We were at the beginning of 2009 in front of the situation that we assumed the dollar yield will go up. And we got from all the nice enablers, politicians, rating agents, accountants, gadgets, indicators where to go. And I just grouped them a little bit. The current regulation in Europe called Solvency I, US GAAP as applied by most of the countries around the globe, IFRS as applied by the most companies of the globe, were telling us, even in our balance sheet, we have asset and liability. They are more or less 100% matched. So yield going up and down plays on both sides of the balance sheet. Economically, no threat, nothing. But all the systems tell us, go short against the dollar bonds, otherwise you lose in these measures equity. And if you go to, luckily, new Solvency II, if you go Standard & Poor's or Swiss Solvency Test or our internal economic tool, they tell us, keep quiet, don't take a bet against the yield. So you're flying a plane, and now you're in the situation, you can say, okay, if I would like to be sustainable, I do nothing, because my balance sheet is not threatened to that. But what happened, a simple figure for the world, if the yield in the dollar goes linear up 2 to 3 percentage points, this would destroy for these companies more than 50% of their capital. And this would be a systemic risk also for the banks, because this suddenly all the shareholders in our industry might get panicked for no reason. I would call this a man-made risk, and this is something we can quickly, nobody's talking about this we can solve quickly. So we would like to steer the company, but please, not everybody, his gadget, and if I have to take a decision, one is saying going east, the other going west.
Stefan, thanks. Bob, how about from your perspective?
It's not just important, Suzanne, it's critical. And I think we have an opportunity as we sit here this week through the G20 to have some real international coordination around effective regulation. It's difficult. We've seen elections in the US, we've seen elections in the UK, and I think if you step back and think about that, And these are two of the most important countries. What we really need is we need a strong financial center in New York and a strong financial center in London. But elections are by nature national. They're not global. The companies we deal with, whether pension funds or corporates, have global operations, almost all of them. The financial markets are global. And this is a time where isolated actions in the US or the UK are not beneficial when compared to the opportunity we have to work constructively through the G20 and through the Financial Stability Forum. Two simple examples that we saw in the US over the last couple of years. The original charter of Fannie and Freddie was to provide affordable mortgages in standardized form to middle-class Americans. It wasn't to run the biggest derivatives book because of a regulatory loophole. The derivatives positions and the CDS positions at AIG were not in the core insurance company. They were provided in a sub, again, through a regulatory loophole. A level playing field is critically important, and we have that opportunity today with the G20.
Thank you. I'm going to talk a little bit about kind of, again, what effective regulation is, because everyone's referred to it on the panel. And I think Guillermo kind of highlighted some of the political considerations that are driving change. But Guillermo, from your perspective, how do you insulate really the regulatory reform process from the hazardous aspects of politics?
Well, let me first perhaps make an observation following Jaime's initial remarks. And this is the following. If you take any emerging market that had a crisis, a financial crisis, in the 80s or the 90s, there were many of them. We had in Mexico a huge crisis in '95, and then this was followed by a series of crises in Asia, Russia, then Brazil, Argentina, and so on and so forth. None of these countries suffered a financial crisis in this episode as a consequence of the global crisis. It is very remarkable that the financial sectors in all emerging markets were able to resist this global crisis. And of course, there are many cyclical factors that affected them. For example, the non-payment of consumer credits and so on. But most banks were able to resist this very strongly. This suggests to me that we do learn from our mistakes. And in the case of many of the emerging markets, strong regulation was put in place after our own crisis to avoid the kind of problems that led to the crisis in the first place. That is, excessive lending, currency mismatches, maturity mismatches, and so on. So I think this is a very important point. So to go to your question directly, I think that the kind of model that most emerging markets use in terms of the operations of major banks in our markets was one where the subsidiaries of these banks are subject to local regulation, and they are subject to local laws and treated like local banks with their own capital, liquidity requirements, and so on and so forth. And this seems to have worked. So I think that the kind of model where the parent banks have subsidiaries across the world, and these subsidiaries are, again, subject to local regulations, and there is not a centralized, let's put it that way, model where all decisions are taken at the level of the parent bank, is the one that works. Because as long as you don't have a global regulator, a global lender of last resort, or a global taxpayer, which are the real, I would say, political issues. This is the kind of model that, in my view, did work and should be the blueprint for the future.
Ibrahim, I'm just going to follow up and turn to you because one of your opening comments suggested that persistent global imbalances ultimately undermine anything we might do on the reform side, from a regulation point of view. Do you want to expound a little bit more on that from your perspective?
Yeah, I would like to expand on that. Basically, unless we really tackle these global imbalances, I don't see that there is any solution, or if it helps in the way of solving some of our problems. But I would like also to comment a little bit on what Guillermo was saying about banking in general from our perspective. We as emerging markets, because in our case, apart from the macro-prudential regulatory environment, we have our own micro-prudential regulatory environment, which is, in our case, in the emerging markets, the regulators are really on top of things. They're not behind the curve, like, for example, in the US or in Europe, in many cases, simply because we are we are simple commercial bankers. I would like to refer to what Guillermo was saying. It's the difference between commerce and commercial banking. We don't have those sophisticated products like the derivatives and others where the regulatory environment is not there. I mean, the hedge funds and all these products, they are not there, and they will never be there. I don't think that the hedge funds and the other complicated products were ever regulated, or will ever they be regulated, because we don't understand the risk. So it's a question of risk management at the end. And that's why in most of the emerging markets, and probably in all of the emerging markets, we didn't really have a problem, although we are very much interconnected. I mean, after all, this is a global village, somehow. Whatever happens in the US or in Europe, in a way, at least psychologically affects us. But we didn't have any problem. I mean, you go throughout all the emerging markets, we didn't have a crisis in the real sense as we saw it in the US or in Europe. So I wanted to point that perspective from an emerging markets perspective.
Thank you. Jonathan, we've talked a little bit about the separation of commerce and finance as being kind of one of the goals here of some of the reform efforts. I wonder if you just want to comment on any kind of adverse effects you see out there potentially on the horizon from that idea.
Well, first, I just want my friend to know that I'm actually not a banker, and I feel a little bit sometimes like I wandered into this room in a fight between politicians and regulators and bankers, and were caught somehow in the crossfire. And there's some irony in that, because I think among all asset classes, and this crisis, I think, demonstrates the point, we were among the safest class of assets in the crisis. I mean, as compared, I used to think private equity was actually a very risky business until I saw the performance of real estate, hedge funds, just about, everything that was because I knew less about it, I thought was safer. And my gosh, I'm lucky enough 26 years ago to pick the right industry. On consequences, first, there will be unintended consequences because there always are. And, on the one hand, the private equity operation, since this is about banks, the range of possibilities, and that's all they are now because we don't really know how this will unfold. The range is everything from nothing changes, because that happens often, to they're actually need to be hived off, to something in between where they're segregated so that, particularly for financial institutions with insured deposits, somehow it's not commingled with other non-customer related, quote, riskier activities, they're never contaminated by those deposits and any attendant rescue if necessary. That's the middle ground, which, by the way, is probably where we'll end up, and that seems to make sense on a fairness level, that it does seem right that where you've got depositors' money, that is normally associated with traditional banking activities, how does that all of a sudden seep into private equity, which is our world? So selfishly, I would say that's not a bad thing. That, in effect, eliminates a competitor because banks are, in some cases, competitors to us. I think that's a selfish view. I think it is probably, and if the regulations, the new regulations are smartly crafted, should have very little effect on a sector that's been, I think, stable and responsibly managed. There are actually, although it's a high profile, private equity, I think, gets a disproportionate share of attention. I think it's because it's easy to personalize, and everyone loves to do that. Firms, there are firm leaders who tend to represent not only their firms but the industry, and so that's fun to look at them, and whether they're doing really well or not, they attract attention. But the truth is, in the banking world, we're a very small business as equity stakeholders. That I think banks, as investors in private equity, represent about 12% of total capital of private equity, and private equity is small to begin with. So it's both not a huge factor inside of private equity, and by the way, as sponsors, as GPs, I think the number is even smaller, because there are only a few banks that are engaged in a significant way in private equity. So I don't think, in terms of supply and demand, it will have a significant effect. There will be a significant second-order effect in private equity, and by the way, other innocent bystanders, if banks are forced to contract. That is the too big to fail issue, which I've been consistent. I think that's different than systemic financial risk, although they're often treated as the same thing. I agree with Bob's earlier comments. I think banks in the traditional spaces where we're generally engaged with banks, their growth responded to the demands of customers like us. And we like big banks because they can support us in a variety of activities that smaller banks cannot. And so I assume that those folks who are managing big banks didn't get up one day and say, we just want to be big. It was a response to competitive conditions. And it's a philosophical issue, by the way. Too big to fail. I haven't seen any study that suggests we have the foggiest idea of what constitutes too big. I don't know what that would be. As a customer, though, we can differentiate those banks that can perform for us, and those are the banks we choose to do business with. Yes, we want to see a competitive banking system. We don't want to see a rigged system. We don't want to see an unlevel playing field. But I think it would be a shame to contract them in the name of reducing systemic financial risk, because I don't think there's a connection, and there is a cost, as I see it, as a customer of banks.
Thanks. Bob, maybe just a follow-up on that. You've just heard your customer speaking. When you think about the macroeconomy, are you concerned that these reform efforts are going to do some damage?
Sure. I think, I talked a bit about isolated actions driven by domestic concerns, often around an election, which is inherently a national issue as opposed to a global issue. So what are some good examples of unintended consequences? We talked about the new potential rules in the U.S. around private equity, around hedge funds. I think the one I'd touch on is proprietary trading. And it's very, very difficult to think that we can differentiate between the risk banks take in their normal course of business for their clients and customers in proprietary trading. And I think, to give two examples, the United States government has about $8 trillion in debt outstanding. That's Treasury bills, Treasury bonds, Treasury notes, Fannie and Freddie and agencies. Of that 8 trillion, over half of it comes due in the next 18 months. So without any new financing, that's 4 trillion. We haven't used words like trillion for a long time. And banks like Barclays, who are sophisticated and leading players in the government bond markets in the US, in the UK, in France, in Germany, and Japan, trade those securities with their customers, both hedge funds and pension funds, but they also place them in Japan and China. And so there's a real need for banks like Barclays, who has the #1 market share with the US government, to be an active trader of those securities every day, every hour, to provide liquidity in the market. I think there's many other examples. John talked about the private equity market. If we think of the equity markets for our corporate clients, it's clearly our obligation to be providing lending and provide loans. It's hard to differentiate that from taking positions in their equity or taking positions in their mezzanine debt, which could be looked at as a proprietary trade. So I think it's very important to step back and be very thoughtful about the role of trading and the role of risk in banks, because without risk, we don't have a banking industry. And I think if we step back a little further and say, what is this all about? Why are we trying to look at regulation? We want to have a safe and sound financial system, and we want to have jobs, and we want to have economic growth. And I think having banks that are well managed, that are willing to take risk, and particularly willing to take cross-border risk, are essential to have jobs and economic growth. And we want to have that in a financial system that's safe and sound.
Thanks, Bob. Jaime, I'm going to turn to you because it's been referenced now by both Guillermo and Bob that it's quite challenging at the end of the day to separate proprietary trading from market making, as an example. I thought you might want to comment, how at BIS you think you're going to confront that challenge.
Well, perhaps one comment before of that, because I've heard several comments on too big to fail, and in the way it has been presented, it seems like the regulators were thinking in terms of a list of too big to fail institutions or something like that, and perhaps this has been at the past, but I don't think that this is the state of the situation. The analysis of too big to fail is more analyzing what are the key drivers of the contribution of institutions or financial institutions to the whole systemic risk. And the systemic risk is higher than the addition of just the individual risk or the calculation of individual risk on each institution. And that's what it is tried to be, and size is one of the elements, but as it has been mentioned, it is also the interconnection, it is the business model, there are the complexity, and that is, and the debate is going to be in different areas, as I mentioned. One, it will be to what extent is additional capital that will be needed for some of these activities or for some of these institutions that are more systemic. And again, just to clarify, systemic is not only the probability of having problems, it's also what happens if at the end you have problems. What is your impact in the whole economy? And that is the analysis that is being done. Now, your question is a very difficult question, and I think this is part of the necessary gathering data that will occur during this year. And it will be necessary an effort. I think there has been the proposals, for example, by the Basel Committee have been public in December, so there is a clear direction that has been set, but it was also said that this will be need to be explored, analyzing what are the impact, and that's one of the things. Analyzing also what are potential changes and the effects. So this will be the work that is going to be developed during this year. And some of these ideas that have been presented will have to be analyzed in the context of additional data that will have to be gathered. We all know that we want a more resilient financial system, that is able and more stable, that is able to provide credit to the economy. That's very important, and this is what is going to be analyzed during the year. And some of these difficult questions of delineating is not going to be at all very easy. And this is just among the range of options that are available. And at the present moment, we have a range of options that have to be discussed by the regulators.
Jaime, thank you. Before opening it to the audience, I'm just going to ask one more question to Guillermo, which is what types of systemic risk are we not talking about today that you foresee in the future that maybe we should be?
Well, I think that if we look at history, all financial crises, and this is not the exception, have very many of the same components. I mean, the difference between previous financial crises, except maybe in the 30s and this one, is the scope, the severity, and the global nature of it. And this has to do, of course, with a much more interconnected world and with the growth of cross-border transactions and cross-border banking. Now, what risks do we see in the immediate future? I think one of the risks is the different stages, I would say, of the stimulus packages that have been put in place to stem off this crisis. And let me just give you an example and talk a little bit about monetary policy. It is pretty clear that the major central banks in the world are likely to maintain very low interest rates for the foreseeable future. We have obviously excess capacity in the world, low inflation, at least in the next couple of years. And, the risk-taking has been, I would say, interrupted in the past week by certain very clear events, which is Greece and the sort of uncertainties regarding the U.S. proposals, Mr. Bernanke's reappointment, and so on. But this will fade away. And I think that the so-called carry trade, that is, the renewal of strong flows to emerging markets is something that we will be watching closely, and something that will probably happen over the next year or so. And this will have the consequence of appreciating assets all over the emerging market sphere. And, emerging markets will try to fight it. But this will potentially cause worldwide bubbles in different sectors, particularly in emerging markets. It's already happening. So I think that if we talk about future risks, this is one that we have to be mindful of.
Guillermo, thank you for that. And I see everyone on the panel shaking their head in agreement. Why don't we open it up to the audience at this point for questions to our panel? Any questions out there? It's a quiet group in the morning. Oh, please. Okay, please. You can just walk a microphone over to them. If you could just state your name and your affiliation for the audience, that would be great.
Steve Coltis from CVC Capital Partners. We're also a private equity firm based in Europe. One unforeseen consequence I haven't heard discussed is on the quality of management. If you look at the banks that survived and you compare them with the banks that didn't, I think everybody can agree that there was a management quality issue that was behind it, as well as the systemic issues that were discussed on the panel. Are we, in discussing the systemic problems, are we not discussing the symptoms of poor management? And if we overregulate the banks, will that have an effect on the quality of management? compensation, for instance, where there are other places they can make their money in better ways if they get regulated to levels that are unattractive. And also, if you take away all of the options a manager has to manage the business as well as possible, are you going to create a band of managers who will create the next crisis? So my question is really to the panel, is that even discussed among the regulators as an issue? And where were the board of directors of the banks during this crisis, and why did they allow these managers to do what they did?
Bob, why don't you maybe address this from the standpoint of incentives going forward, and then Jaime, if you can then talk about it from a regulatory point of view.
Listen, I'll speak from a bank point of view, and it's something that, I think goes unsaid. There's a tendency, it's kind of a tough time to be a banker. People throw us all together to some extent. I will tell you, Barclays, everyone on the team is so immensely proud that we never took any direct money from any government anywhere in the world. And we weren't the only bank that survived every single reporting period with profits, taking no direct money, yet we recognize that we benefited from the incredible monetary and fiscal stimulus. But here's the important point. So did everyone. So did every government, so did every private equity firm, so did every asset manager. The system was saved. And I think what goes unnoticed is that the banks that stayed strong and were well managed through this are angry at the banks that had poor management, were allowed to have poor management, and had ineffective regulations. So the fact that there were failures anger us as well. And I think it's our responsibility to work to be part of the solution now. And I think that's what all the banks are doing. It's both our obligation and our responsibility now to be a part of the new revised regulatory framework. And I would just say, lastly, once again, I think it's critical that this is done in an integrated basis around the world. All the banks know, and we've known for quite a while, that in the new world we're going to work with more capital, with higher quality capital, with less leverage, with bigger pools of liquidity, and in an environment with more intrusive regulation. That's good. That's not a bad thing. The one thing I would ask for is that regulation is also connected between the major economies around the world.
Susan, can I touch?
Ibrahim, please.
Yeah, as far as compensation is concerned, and I think this has come out as something very, very serious. And I know that like Bob was saying, bankers have been attacked. We are the underdogs at the moment. But basically, without incentives, also bankers cannot work in the first place. I mean, you have to have some sort of a formula where incentives are there, maybe not too much incentives. But how big is too big? I mean, it's like too big to fail. How big is too big? So the same case with incentives. You have to find a balance whereby incentives do not become too crazy to be able to go overboard, or too small, really, to not to give you any incentive to produce. That's one thing. As far as the board structure, I agree. Basically, corporate governance was one of the main problems that we had as an item in our global crisis. At least some board members, especially the external board members, should be much more involved. And I think Sir David Walker made that very clear in his paper when he presented the corporate governance paper, that some of the board members should definitely be much more involved than they are. In many cases, board members are more or less they attend board just to say yes or no. But they should be maybe ex-bankers, maybe retired bankers, but they should be much more involved. That's how I see it from a practical point of view.
Thank you. Jaime?
Yeah, I think regulators are very conscious that there is a balance between quality of management and regulation. Certainly the purpose is not to over-regulate, is to regulate properly. And quality of management, when I mentioned the different areas, I said that regulation was part of the solution, a very important part, but there was an important part that came from the private sector. I didn't expand on that, but it was really that. This is the quality of management. And I think the regulators, what we are trying to do is to provide, through regulation, some of the incentives and perhaps to eliminate some of the problems of collective action, that some companies may not do it and others may suffer from what others do not do. And regulation, to some extent, may help on that. But certainly the objective is not to constrain management so that they cannot take their decisions that they have to take. Is to realize that sometimes the incentives are not the appropriate and regulation have a role to play. But it is a balance that needs to be done, and the corporate governance need to be improved. I fully agree. I think all the codes, etc., but then they need to be applied. And I am sure that the regulators are going to place a much more important role in their active regulation, which was my second point, in the more proactive supervision and oversight of the institutions, to the issue of how the governance and the decision-making and the attention to the risk management side of the business is done by the institution. So I hope that we find this balance that Bob was asking.
Great. Guillermo?
Let me just follow briefly on Bob's point, Michel. The essence of banking is, of course, to bridge and to bring savings to the most productive use, to create employment, and to create and to facilitate economic activity. When banking operations are removed from that essential purpose, and banks essentially engage in betting on different states of the world, which are far removed from anything that has to do with economic activity. And this is what I'm talking about, is these very complex products that some banks designed and kept and warehoused and arbitrage regulation and not only sold to investors but kept themselves. But these products were totally, again, unrelated to anything that has remotely to do with economic activity. Those kind of activities, obviously, are not helpful. And if banks are willing to bet on those products, I mean, they should do it without involving taxpayers' money. And I think that's what Bob was saying, in the sense, there are banks that engage in this type of activities and did very poorly. Not only commercial banks, but investment banks and institutions in general. So I think that second point, as Jaime was also pointing out, is that what you need is a balance. It's a balance between what is needed. I mean, banks are needed. Banks that take risks are needed. Banks that do cross-border business are needed. But at the same time, you want to avoid the kind of reckless behavior that we saw on the part of some players, and that brought this whole house of cards down. So I think it is essential that we arrive at some sort of consensus in the bodies that have already been established to study the subjects, like the G20, like the Financial Stability Board, and so on, and to achieve some sort of homogeneous thinking on this subject.
Other questions from the audience? Please.
Jens Hultveit, Mo, Umo, Norway. This past hour has been kind of amazing. It's so polite. You wouldn't believe that a year ago the world was in crisis due to the financial industry. Probably that's because none of the villains are present. So my question really is to you, how can we assure that the villains are cleaned up? And notably, to Barclays, who actually tried to buy one of the chief villains, Lehman Brothers.
Bob, do you want
quite understand the question. If you could
can you talk a little bit more about how you...
Sorry. In the financial crisis, you had Lehman Brothers, you had AIG, you had hedge funds, you had speculators, UBS. None of them are present. Yet, to clean these out of the system seems important. Still, you, Barclays, wanted to buy Lehman Brothers. Why?
Great question.
Did everyone hear the final question? The final question was, why did Bob consider buying Lehman Brothers, given that they were one of the so-called villains?
I think you have to step back and look at our strategic positioning. And it's a credit to our board and to the kind of governance in the last question that was asked, is when the crisis was clear in the summer of 2007, that long ago, and it was clear not the depth or the length of the crisis, but it was clear with the things that came out of UBS and a number of other institutions that summer in terms of write-downs and positions, that there was going to be consolidation in banking. Barclays had a great investment bank in Barclays Capital, but it was very much a European institution that had begun building its U.S. business. And it was clear early on that there may be some opportunities. And without going into a lot of detail, our executive committee and our board felt if one of the bulge bracket investment banks in the U.S. was available at a distressed price, it would be unbelievable opportunity for Barclays to combine that with a very strong European operation of Barclays Capital. I think also, and when we look at it, Lehman is a great organization. They made some real mistakes, and it comes back to the issues we talked about in terms of risk management. Interestingly, they didn't have a lot of leverage, but they had a tremendous amount of commercial real estate and illiquid private equity. And one of the things, if I can just use this as a side story about the importance of capital and the importance of regulation, in a $600 billion balance sheet on Lehman Brothers, $10 billion was in illiquid various private equity positions. So it might have been 100 different positions. And it wasn't a valuation issue. But if we had taken that onto the balance sheet of Barclays Capital and Barclays, it would have used more capital than the entire investment bank in Barclays because we were under Basel II. And so one of the effective tools isn't to create all kinds of different rules of you can trade this, but you can't trade that. We can approach it in a coordinated way with capital rules. And I think that's one of the lessons that came. But to come back to your original point, the success for Barclays is that we have a much stronger strategic positioning in investment banking, far more profitable, and we saved 10,000 jobs of people that were doing a really good job in New York.
Thank you. Well, we have time for one more question, maybe in the back.
Hi, I'm Bob Forbes from Forbes. Question, we've been talking somewhat about the recklessness of what we've seen going on in the banks themselves and in the financial community. How do you address the recklessness of basic government policy, particularly in the U.S., with, let's say, a Fannie and a Freddie printing too much money, mark to market, that almost drove more banks out of business?
John.
It's a great question, and and one of the failings so far, I think, in responding to the crisis and thinking about what regulations we need is first getting a little bit away from the blame game, which is, I think, human behavior. We need someone to blame for this. And it can't be government, it can't be regulators, it can't be consumers, it can't be borrowers, so it must be banks. And I think that starts us down the wrong path because, in my view, we all share responsibility for what happened here. The trigger point may have been mortgages, but there were, when you talk to bankers who talk freely about, there was reckless lending, there was reckless borrowing too. And it was all with the backdrop of public policy that it was a desired outcome. The greater the percentage of population that could own a house, didn't matter if they could afford it or afford to maintain it, that was good public policy. And we tend to forget that right now and look to Wall Street. And I can say this because that's not my business, but just watching the debate, it doesn't seem healthy to me unless we're all sitting at the table thinking really dispassionately about how did we get in here to this mess and how do we get out. That's why I'd like to see smarter regulation. I think a big part of it, whether it's Lehman, the prior question, or AIG, has to do with resolution authority that didn't exist except through bankruptcy, which is a very ugly outcome. Take out of the hands of the regulators, put it in courts, and it goes on for years. I think failures are part of all systems. We just need a responsible way of managing them so it doesn't become contagious, so assets and good employees can be transferred efficiently. And we need corresponding public policy that makes sense. I mean, what tends to happen, it's happening right now, is that regulation tends to be pro-cyclical, just the opposite of what we need. We tend to tighten in bad economic environments. I mean, capital requirements are surely going up now, which I think is appropriate, but we loosen them when things are robust. And when we devise the right regulatory framework, to me, it would be one of the desirable, in addition to all the other attributes that we talked about on this panel, is there should be a corrective element, that it should be counter-cyclical. And that's the problem with regulation. Crises are macro, and regulation is micro. We focus on institutions when what we're really worried about is the system at large. So I think it's a great question.
Thank you very, very much for that question, and thank you to all the panelists. So despite their politeness, hopefully you got a sense that there are some varying views here, and at the end of the day, I think there was agreement that banking is going to be a critical function to economic growth, and it's clearly got the public trust. Thank you all very much.